Superannuation is an extremely confusing investment vehicle, especially one that's compulsory for all Australians. And it's really kind of amazing the difference you can achieve over a long period of time just choosing the right investment option. So for example, if you took $100,000 30 years ago and put it in the high growth option versus just the default balanced option with the super fund, you could have over $1.6 million now, which is $800,000 more than if you had just left it in the default balanced option. I actually recently swapped up my super investments to a high growth option, and in this video I'll go through my evaluation process and also present you guys with some high growth options to consider as well. As always, the ideas presented in this video are general in nature and I'm not a financial advisor, so remember, always do your own research. And also remember to smash that like button to help with the YouTube algorithm. So let's get started. The first thing I wanted to cover is the difference between risk and return. When you sign up for any superannuation fund, they'll often suggest a default option into their balanced fund. And this balanced fund will often have a 70-30 weighting between high growth options, stocks, and 30% towards more conservative options like bonds. However, this allocation between equities and bonds typically isn't optimal for a young person who's looking for high growth over a long time period. Why is that the case? Because the higher risk that you take, the higher expected return that you'll get. But that also increases the range of potential outcomes. And there's no guarantee that your actual return will be the same as your expected return. It is just an estimate. And to get this higher return, you face the risk of any range of possible returns for the risk that you're taking. And as a young person with a long time horizon, this isn't actually as bad as it sounds. You actually want to look for investment options with higher risk volatility, because over the long term, these will have higher expected returns. Yes, in the short term, you may hit those lower lows, but you could also hit those higher highs. And given that superannuation actually forces you to wait until you're 65 or older maybe, before you can access it, over the long term, you should expect to get closer and closer to that average expected return. So for a young person, I would avoid any defensive asset allocations in your superannuation because you have such a long-term horizon before you can access your super. Our next problem with most default balanced superannuation options is that they typically have relatively high fees when you look at it versus an indexed passive option. And this is because they're what you call actively managed funds. And this basically means that they need to employ an expensive fund manager to actively trade and reallocate investments within that fund.
I didn't realize that there was anything to manage with CDOs.
We select the securities that go into the CDO portfolio and monitor the assets.
And it's never actually guaranteed that these fund managers will even beat the return on just the index of the market. But what is guaranteed is their higher fees when compared to a passive super option. Take Sun Super for example. Their default balanced option has total fees of 0.65% per annum versus their Australian shares index option, which only has 0.09% per annum. On a superannuation size of $100,000, that's $650 a year versus $90 a year, which would be okay if they had higher returns on that balanced fund. But remember, they have 30% defensive asset allocations in these balanced options, so that's going to be almost impossible. And there's another fee you've got to keep in mind, which is the administration fee. This is essentially a fee charged by the superannuation company to manage your investments, and it doesn't change depending on the investment you choose within the company, but it can differ between companies. And I'll go into those in more detail into the comparison section. So my final issue with most default superannuation options is they're typically really heavily weighted towards Australian shares and Australian property. I won't go into too much detail into why I think the Australian market might not necessarily be poised for really good growth over the next 10 to 20 years. But regardless of that, you typically don't want to have all of your investments tied up in one place. So say, for example, the Australian market started tanking, not only might you lose your job and your income, but your superannuation would be at risk as well. Whereas if you chose a more diversified option, where you have investments in other countries all around the world, even if you lost your job in Australia because of the economy, at least your superannuation would be diversified and not hit so hard. So for the comparisons, I'll just outline the assumptions that I'm going to make and use. They'll all be based off $100,000 as the starting base, and they'll be using historical returns over the last 10 years, unless otherwise stated. I won't be including any insurance options because they just add more fees and they might not necessarily be useful for everyone. And they'll be based on the suitability for someone who's got a long-term investment horizon over the next 20 to 30 years, and that somebody who wants a higher appetite for risk. And I'm only going to consider options that are passively indexed because they'll have much lower fees in general as well. And at the end, I'll show you a table which will compare all the different options so you can easily determine which one's the right one for you. So the first option I'll show you is from Sunsuper, and it's the International Shares Index Unhedged option. And the index that it's tracking is the MSCI World ex-Australia Investable Market Index, unhedged, which is more or less international equities minus Australian companies. Unhedged meaning that you're basically exposed to any currency fluctuations between the Australian dollar and the US dollar. In layman terms, this basically means it's good for you if the Australian dollar goes down compared to the US dollar, but bad if the Australian dollar goes up in comparison to the US dollar. So this has administration fees of $1.50 per week, plus 0.1% per annum, with investment fees of 0.11% per annum and a historical return over the last 10 years of around 10% per annum. So the next option is the Host Plus International Shares Indexed option, with an admin fee of $1.50 per week, investment fees of 0.09% per annum, and a historical return of around 13% per annum over the last 10 years. And the Host Plus option actually just tracks the MSCI World ex-Australia Index, which is a very similar index to the Sunsuper option as well. And this next option is from Rest, and it's their Overseas Shares Indexed option. This has administration fees of $1.30 per week and 0.1% per annum, investment fees of 0% per annum, and a historical return of around 12% per annum. This index is actually really similar to Host Plus's index, but it's excluding any controversial companies like tobacco companies. And this last option I'll show you is from First State Super, and it's their International Equities option. They have an admin fee of $1 per week plus 0.15% per annum, investment fees of 0.09% per annum, and a historical return of around 12% per annum. And they are actually tracking the exact same index as Rest, and that is the MSCI World ex-Australia ex-Tobacco Index. So in summary, all of the options I showed you are actually pretty similar. They're all tracking very similar international-based indexes that have high growth potential, but I wouldn't actually pay too much attention to these historical returns, as we all know past performance doesn't necessarily indicate or predict future performance. Given that they are all tracking very similar indexes though, I would instead focus on the fees paid in a year and the differences between them, with both Host Plus and Rest performing slightly better than Sunsuper and First State in this regard. One thing to note though is that while Rest fees are slightly lower on a $100,000 balance over 1 year, as you can see, since their administration fee is more weighted towards a percentage per annum, on higher balances, Host Plus may actually be cheaper fee-wise. So definitely do your own analysis here and pick whichever makes more sense for you. So yeah, if you found this video helpful at all guys, please smash that like button. It really helps me and the YouTube algorithm, and it might get the video in front of other people as well. If you got any questions, leave a comment and I'll make sure to answer it. And if you want to see any more videos like this in the future, subscribe.